Hello everyone and welcome to Fun with Fitzy. Today's video is the fifth video for chapter 11 and it's 11.4. Today's topic is merchandising returns and allowances. So basically purchase returns or sales returns. You know, when you go to a store and you return something, well, you're going to call that a purchase return and the store will call that a sales return because you purchased it and they sold it. So let's take a look at the topic. Here we have a source document. It's a sales invoice, as you can see, and it's recording the sale, which we did already at the beginning of this chapter. So when you record a sale, you're going to, and this was on account because of, or sales invoice. So in the books of the seller, often known as the vendor, they're going to have an accounts receivable. They're going to credit their sales, and then we just switch the switch the GST to HST just for the simplicity of this video. Okay, so we know that that's what the journal entry looks like for the sale. Occasionally, the vendor may need to issue a credit invoice, and this would be to adjust, correct, or cancel a charge to a customer's account. This may be the result of defective goods that are returned. So if you buy something and they're broken or something, you don't want to keep it. Obviously, you want your money back. Less than satisfactory goods that are kept by the customer but require a reduced invoice price. So sometimes companies buy stuff and they get a shipment of it and it's defective. So it doesn't make sense to return it because the seller isn't going to do anything with it either. So they're just going to give the money back for the defective goods. And you have such a relationship that they're going to trust that there is a defect. Or there may be an error made on the invoice which needs to be adjusted. So let's take a look at a return then. So the same purchase invoice here, here's a return. So they're returning 8 packs of these Sky Blazer red signal flares and equals $148 plus the tax, okay? So what does the return journal entry look like? Well, we're going to do the opposite. We're going to debit sales and the HST payable. Be careful, it's not HST recoverable, it's HST payable because we're reversing it. And of course, the accounts receivable is going to go down by that amount that they've returned. In the books of the purchaser, this is what the journal entries look like. We know how to do that. When you purchase merchandise, you debit purchases in the periodic inventory system. And of course, you have to add the tax. And it's recoverable because, as you know, when you purchase something, you are able to recover the tax back from the government. And of course, you owe the money, so therefore you have an accounts payable. With the return now, it's going to be the opposite. You're going to debit accounts payable because you no longer owe as much. You're going to credit purchases because your purchases have gone down. And of course, HST recoverable. Normally we debit HST recoverable, but in a return situation, we need to reduce the recoverable because you can't recover as much. Now, sales returns and allowances sometimes need to be tracked individually. The way we just did it, companies cannot track how much they purchased if they don't track the return. Companies want to track their sales and their sales returns separately. The way we just journalized it, companies can't ultimately see how much was purchased and returned unless they go to that account individually. So here, when you look now at an income statement, you're going to be able to see clearly how much the sales were and how much the returns were. So we're going to use an account called Sales Returns and Allowances, which keeps things separate from sales, so we can see how many returns there were. We do this to accommodate the tracking of the returns, and so we create this new ledger account that we call Sales Returns and Allowances. Sales Returns and Allowances is a contra revenue account, and you recall that contra accounts have an opposite balance to the account normal balance. So here in this case, revenue normally has a credit, so a contra revenue has a debit. So sales returns and allowances is a normal debit balance. Purchase returns and allowances then are going to be the same. The company doing the purchasing would set up a separate account called purchase returns and allowances so that they can keep their returns separate from their purchases and be able to track it. So separate ledger account, and it's a contra expense account. So because expenses normally have a debit balance, a contra expense will have a credit balance. So purchase returns and allowances have a credit balance. So this is what it looks like on the income statement. Here's the sales, less any returns and allowances, and here you can see we've moved it over to the middle column. We had our sales minus any returns, and now we call it net sales. Keep that in mind. Okay, net sales is your sales minus your returns and allowances. Now, in the cost of goods sold section, we've talked about the cost of goods sold formula. Your merchandise, your beginning merchandise plus net purchases, which is your purchases minus your purchase returns and allowances, equals your net purchases. Plus freight in, subtract what you had at the end, is your cost of goods sold. So there's your whole formula here in the cost of goods sold section of your income statement for a periodic inventory system. So by now you should be able to prepare adjusting entries for merchandise returns in both the books of the vendor and the books of the purchaser using purchase returns and allowance and sales returns and allowances, as well as not using those accounts, just reversing the sales and the purchase. Hope that helped. Thanks for watching, and see you next time.